All right, a very good evening, everybody. Welcome to the live webinar on a new era for the economy, Trump 2.0, de-dollarisation and gold. I'm Ming Hui from Flip Nova, and tonight's webinar is held in collaboration with Apex. Speaking to us tonight will be Mr. David Ng, proprietary trader at Iceberg X. And before I pass the time to David, we will first have Mr. Sam Chong, head of global markets and strategy from Apex, to give us a brief introduction to the exchange. Sam, over to you, please.
Okay, thank you, Ming Hui. Let me share my slide. Hi, Ming Hui, are you able to see my slides in full?
Yes, I can see your slides in full.
Okay, thank you very much. Yeah, without further ado, let me start with my presentation on the introductions to the exchange, Asia Pacific Exchange, APEX in short. Yeah, today I'm going to touch more about one of the new products that we have on the gold troy ounce perpetual futures contract. I'm Sam. I'm actually the head of global markets and strategy. I'm in charge of the product development and marketing for the company. So this is a disclaimer about today I'm going to whatever information that I'm going to share is more for the information purpose only. It doesn't really contribute to any buy or sell order, buy and sell opinions. So a bit about the company introduction. So Asia Pacific Apex is actually an international derivative exchange founded in Singapore. It's the third approved exchange in Singapore, which we also hold about the approved clearing house license after XJX and ICE. So we got our license back in 2018. So Apex actually currently offer products in the underlying of digital assets, financial commodities, and precious metal assets. So today I'm going to touch more a bit about Apex gold products, which is on the gold troy ounce perpetual futures contract. So these are the 6 key features of our contract. So the contracts actually come with 3 sizes: 1 ounce, 10 ounce, and 100 ounce. Which 100 ounce is actually a standard size for the spot market. So we offer 3 card sizes actually to cater for different needs of the clients and different client segments. Second point, which is a high leverage. Actually, our contracts currently requires initial margins about $118 for 1 ounce, so which could translate about 4%, which about 25 times of leverage. So the third point is about the no expiry. So we know that from this contract is actually a perpetual futures contract. So there's actually no expiry. So it actually works basically it's like a CFD or the spot contract with a perpetual rolling function. So which investors actually don't really need to actually roll their contracts for the money futures, which they will be able to open the position perpetually until the investor actually close it on the positions. So number 4 about this is also one of the important point. There's no spread on our swap rate. So if you are familiar with tradings on the gold CFD or spot gold, so we always come with a swap rate which will be actually charged at the end of the day. So on Apex contract, there's actually no spread on the swap. So meaning that I'm going to elaborate more later in the slide, but actually basically it's actually a zero-sum game between the buyer and the seller. So exchange doesn't really apply any spread on it. The 5th point is about LBMA, the benchmark that we use for our settlement of the contract. So it's actually a reputable spot London gold prices that we use to settle our contract. So to ensure that it will be always settled as using a more reputable index. So the 6th point, which is a low trading fee, so it's one of the lowest trading fees among the market for our contracts. So the 3 sizes is 1 ounce, 10 ounce, and 100 ounce. So currently it's trading above 3,000 for 1 ounce. So the contract size is 3,000, 30,000, 300,000. So I'm going to touch a bit more about the contract spec. So the trading hour is actually follow T session and T+1. So we start at 7 a.m. until 6 p.m. Singapore time. This is for the day sessions. And then for the T+1 session, it starts at 7:30 all the way until 5 a.m. Yeah, so here we have also the concept of rollover fees. You can understand rollover fees as a swap that I mentioned. So on a daily basis, we actually calculate what is the swap going to be paid or going to be received by either sides of the positions. So we actually publish it on the website, and also you will be in with the broker. So brokers will actually incorporate this into the statements on the daily segment that they send it to you. And then the settlement I mentioned about is actually US dollar cash settle against the LBMA prices. And then there's a bit of typo here. So the initial margin is actually currently is about 118, which is about 4% also because the price have went up. So in terms of why there's an importance to have a higher leverage on the gold contracts is if you look at the 10 years of historical data based on the LBMA, so based on the LBMA prices, you will be able to see that for the gold itself, the medians of the daily movement is only 0.49%, meaning that on average it actually moved by 0.5%. So the max and the minimum is about 7% and negative 5%. So having said that, actually if was to speculate, were to use the contracts to speculate in the market, right? I think the leverage itself is very important because in order to uh, have the magnified effects on your contract, on your tradings, you need actually a contract which actually provide you a higher leverage. So this the data, the statistic they have actually compiled. If if we go by the number of trading days, total 10 years about 2,759 days, right? Actually, the number of days with the big movement I mentioned here is about 1%. So on the day that move more than 1%, it's only 500 over days, which is only 20% of the day. Yeah. So every probably this mean that every 5 days only you will only see like one day of it moving more than 1%. Yeah, on a daily basis. So we compare the leverage amongst all our peers, all our these competitors. Apex is one of the highest, so we offer about 25 times 4% margin. Touching on the expiry, no expiry. So why is it important? Because it's you actually this perpetual futures contract allows you to hold based on the periods that you want. So let's say you have a view on the market that it will be on the uptrend or downtrend, or you use it for hedging of some of your exposure in physical gold. So this will be very helpful because you don't really have to roll the position. You will actually save a lot of cost on the position rolling, and at the same time, the swap will be actually be applied to the contract, the position holder. So this will be actually fair to the market, and it is more suitable for if someone were to use it for a longer term of exposure. So I come back to this point about the no spread for the swap rate. So this is what I mean. So I compare amongst some of the FX brokers that you'll be able to find online. So you can actually be able to see that on the swap rates on all different platforms. So let's say you are talking about Saxo or Enda, you see that always the long are going to pay. So the positive meaning the long is going to pay, then short negative means short is going to receive. So you always see there's a significant spread between the long and short. So basically, this is actually because of the brokers, the liquidity provider are going to earn from providing the positions, and that's why there's charge a spread on that. But on the Apex contract, because we are not a broker, so we don't charge spread on that. So you'll be able to see that every day when we calculate on the short, when we publish on the website, it always be the same for the long and short. It's just that it's on a different direction. So meaning for the case of last Friday, 21st of March, so buyer actually are paying about 35 cents while the seller are receiving 35 cents. So with this point, actually it's very good for you to utilize this contract for a long-term exposure, because whether you are on the long, you're paying the lowest among the market, And if you are on the short position, you are receiving the highest among the market. So this is very important. So the convention that we use on, if you see on the website, is slightly different. So you see positive rate means the clients have to pay. So if let's say you will see a positive rate on the long side, meaning the long are paying. So if you see a negative rate on the sell side, so the clients on the short side actually receive the amount. Yeah, so it's always a zero sum game. So it rather depends on the negative side is on the long or the short. But of course, for now, because of the high interest rate of the US dollar, so this gold pairs is always in long for long are paying in most of the cases. So coming to this about the benchmark that we use, so the LBMA, if you understand about LBMA, the London Bullion Market Association, so they publish the AM price for this their gold option on a daily basis. So we are using the AM price, which is about 5:30 or 6:30 Singapore time. So this is the one that being used to settle our contract. So it's actually this index is actually administered by the IBA, so it's ICE Benchmark Administration. So it's actually one of the reputable index being used in the spot market for gold. So when talk about the low trading fees, so we only charge about 10 cent for 1 ounce, 40 cent for 10 ounce, and then $1.50 for 100 ounce. So if you look at the standard size, 100 ounce, so basically it's like if you look at it now currently the price about 3,000 plus. So this $1.5 actually means that there's only like 1 cent, 1.5 cents for each ounce of the tradings. Yeah, so which is quite low. So before I end my parts, actually I want to actually talk about the fun fact. So currently, as we know that gold is actually very popular amongst not just about in retails, but also on the younger generations. So we actually see there's a trend of central banks buying a lot of gold. So so do the Gen Z and millennials. Yeah, so 70% of them they trust gold than their fiat currency during the economic instability. So we know that there's a lot of war happening around the world. So people actually trust gold more than their fiat currency because fiat currency is actually is very dependent on depends very much on the economy of the countries and how the central bank actually react in terms of their policy on the monetary policy. So for younger generation now they trust more on the gold. So on the top right picture, so you see that especially in the China, so there are a lot of it's very popular amongst the youngster. They actually save through buying into these gold beans. So these gold beans may be like very small amount, like maybe 1 gram or even less than that. So they save by buying into these gold beans and then they put it into one small bottles. So what they like for example, every 1 week I buy one beans. So I save until I can fill up the whole bottles. Probably when price are good, I probably sell it to the market. Yeah, so this is how they make use of gold to save. So it's actually a good initiative for the younger generation to save through gold. Yeah, and in recent days and months, and we see that gold has reached a new high of 3,000. So I think today David are going to share more about this insight on the goal. So without further ado, I pass on the mic back to Ming Hui. Yeah.
All right,
So
thank you for that, Sam. That was
yeah.
very interesting on the gold beans. And to our
Mm,
audience listening, stay tuned to the end for a very special promotion on gold. And before we have our main speaker of tonight, please be reminded that if you have any questions throughout the course of the webinar, you can just send them into the questions box, and we will address them during the live Q&A session towards the end. And now, without further ado, I will pass the time over to David.
Hey, hi. Thank you, Minghui. Just a quick check. Can you see my slides as well? Can you hear me?
Yes, I can hear you loud and clear, and I can see your screen, full screen as well.
Yeah, okay, that's great. Thank you. Yeah, just before I start, just like to thank Philip Noah as well as Apex for inviting me to speak on today's topic entitled Go, and especially how Go has performed in Trump 2.0. And as we all know, Trump 2.0 definitely ushered in the different type of volatility, market volatility, and therefore Go tend to benefit. And I think the main key question is that Go has reached an all-time high level of 3,000 US dollar per ounce. The next key question is, will this level hold, and where gold is heading next? So I think the next half an hour to 45 minutes or so, I'm just going to share with the audience, some of the key factors that actually affect gold prices, and whether these factors continue to be relevant in the market to drive gold prices to even higher level, or whether, in terms of technical perspective, are we going to see a bit of correction, especially when you see a trend that is so strong on the bullish side. They're bound to have a bit of healthy correction along the way so that the trend itself can sustain over the longer period. So as usual, a risk disclaimer. I think any materials presented here today is purely for educational purpose, and any opinions is purely based on my own personal opinion, doesn't reflect opinion whether it's from Philip Noah or whether it's from the exchange itself. And if you are new to the futures market, derivative instruments does involve a lot of risk. So make sure you are well, uh, gain sufficient knowledge, and make sure you're well equipped with the right knowledge. And I believe Philip Noah in this regard can able to assist you further if you're thinking to embark on your journey in futures trading. Now, I think these are some of the key areas that I'm going to focus on. I think firstly is just looking at now we have truly understand that gold is definitely on a new price level, and I think a lot of positive factors are continuing to drive gold prices, or rather support gold prices in the near term. I think it's important for us to assess whether those factors can continue to remain relevant, especially as we head into, as we have known, Trump 2.0, which is usually be a period where there's higher market volatility, and I think gold tend to benefit in such a period of time. I think in the second part of this webinar, I'll be mainly looking at ways and techniques that you can use to navigate the gold futures market. And I think as if you have been trading the market for quite some time, markets are getting very volatile, be it in gold or be it commodities or even equities market in general. So with every volatility in the market, there's always opportunity for those who are trying to trade the market. So it's good to have a bit of arsenal tools in your technical toolbox to make sure that you are able to navigate the market whenever the opportunity presents itself. And last but not least, I think is growing importance. Gold is gaining significant exposure, not only in terms of portfolio management, but I think in terms of interest. As just what Sam has highlighted, even the new generation, the Gen Z, is really looking into the gold market as an asset class as they're going to hold into the future. So it's interesting if you are someone that have not invested in the gold market. I think this is an opportune time for you, given that even though prices are high, I believe that certain factors can actually drive gold prices to even higher levels. Now, so just a recap on where gold prices is. If you just look at comparing gold and relatively to other major US benchmark like S&P 500, even the Nasdaq, you can clearly see I think gold is the best performing asset class this year so far. And in fact, I think it's beaten the S&P or even the Nasdaq, and to some extent some of the major equities market. So the key question is that gold definitely is a clear outperformer, and the key question is whether can the momentum still sustain itself. Now I believe that in every market, when you see such a strong uptrend rally in the market, it's bound to have a correction, and it's healthy because a trend itself cannot sustain itself without without consolidation in the market, where other participants can participate in the market before heading to the next rally or the next price level. So I think gold is bracing for that correction. It's a matter of time. But I think important between in between those periods, we definitely can see a lot of opportunities that is present in the market. But having said that, I think the longer term view on the gold market is still pretty much a bullish view as long as the factors supporting gold prices remains supportive for the market in general. So just to look at whether we look at gold prices performing in the past quarter or even a year or so, if you just look at over the longer period, even longer period up to 20 years or even 3 decades or so, you can see gold is clearly a asset class that holds its value, in terms of appreciating along with other asset classes. So it's if you compare with equity space, it's really neck to neck. And I think when times of uncertainty, when markets are very volatile, I think gold is tend to be the ultimate beneficiary. So the prospect for gold seems to be bright. Even an asset class is a good diversifier of risk. So I think it brings a question that as portfolio managers are slowly moving out from equity space, the fund flow moving out of equity space, I think the next major asset class that tends to benefit from this such a scenario is always the gold market. So I think we have to keep in mind gold is definitely holds its value as a store of value, and it's definitely an asset class worth to hold, especially during period of uncertainty. Now, here are some of the key factors that affect gold prices. These are all very general, but I think the first key thing is always demand and supply factor dynamics. Now, in gold market, in general, supply is usually very constant. You don't suddenly see a sudden surge in supply coming into the market, unlike other commodities, especially perishable commodities like your grains and other soft commodities. So gold is a very hard asset. So therefore, supply is actually very restrictive and limited. And the key question that drive gold prices is always the demand perspective. So as long as demand for gold remains strong, there is growing demand for gold. Therefore, I think gold prices will tend to be supported. Now, economic climate is also an important equation. If you look at it, whenever you see an economy that is, especially when now you talk about US going into a period where they are slowly seeing slower growth, even China as well. So when you start to see economic climate where is sluggish, gold tend to benefit because there's always the role of gold as being a safe haven asset when things are uncertain, when things are looking bad, especially on the external front. People will just rush into gold as a way to as a store of value or as a safe haven asset. So I think that role still remain important. And that creates an important factor for the gold prices as well. I think third and fourthly is dollar strength and interest rates. So whenever we have a strong dollar, normally that will be not beneficial for gold because gold is priced in US dollar. And whenever when you have strong dollar, that means it's actually more expensive for other currencies or other countries to buy into the gold market because of the strength of the respective currency. So whenever we have a strong dollar strength, that usually doesn't benefit gold prices. Now, same goes for interest rate. You have high interest rates. Keep in mind, gold is a non-interest bearing asset. That means it doesn't pay you any interest. You just hold gold. It doesn't give you any interest, unlike other asset classes like equities market. So when you have high interest rate environment, there's always an opportunity cost. So therefore, high interest rate environment doesn't usually benefit gold prices because gold itself is a non-interest bearing asset. Now, inflation. If you just look at over the decades, every time when you have a period of high inflation, gold tend to be benefit because as gold tends to remain its value or stores its value pretty well, especially in times of high inflationary period. Last but not least, geopolitical risk is an important element. Right now, we have, although we have Trump that's ushering a lot of uncertainty regarding tariffs implementation, there is also geopolitical risks, between certain regions. So therefore, I think all these are confluence factors that are actually pushing gold prices to even higher levels. Now, if you just look at gold prices in general and how it performed in relation to equity prices, you can see that whenever equity markets tend to do badly, especially when it's down by almost one standard or two standard deviation, you can see gold actually perform very well in those periods. We have seen that during the COVID pandemic. So I think gold remains still an important role, especially as a way to safeguard against whether it's economic or market risk. Now, I just want to highlight key segments when you look at economy per se for this year and throughout the year throughout the second or even toward the end of the year is basically the risk of US heading to a possible recession that's in place. Now, if you just look at the stats that is coming out from US market, I think one key thing we have to acknowledge is that I think things are not looking so good on the ground. Although sentiment-wise, the unemployment is still pretty low. But you just look at consumer sentiment and especially inflation as a rate or as an expectation is actually inching higher. So it goes to show US probably may be facing a period of slower growth in future and coupled with inflationary pressure. Now, tariff is usually quite it drives inflation. So you have tariffs that's implemented across the board or respective, importing countries. It will definitely feel inflation. So I think this is something to watch out for. It will create a lot of uncertainty in the market in regards to equity space. But I think ultimately, I think gold tend to benefit in such a scenario. So we have a period where US is possibly going to go to witness slower growth in time to come, and we couple with that we have a higher inflation expectation, which is probably going to be something that is going to benefit gold in the longer run. Now, this is what I meant. I think consumer sentiment on the ground seems to signal that despite the unemployment numbers are still pretty low in US, but consumer sentiment wise is actually quite sluggish. I think this is what is tipping point, and Federal Reserve is watching this very closely. As long as inflationary is still between their control, interest rate decisions are paramount. And if you have been trading the gold market for quite some time, if you want to avoid high volatile periods in the gold market, avoid FOMC days. Usually those days, gold market tends to gyrate. Prices of gold market tends to gyrate very violently, and I think that will create a lot of uncertainty in the market. So I think going forward this year is going to be the same sentiment. Prior to any FOMC meeting, I think gold prices will be slightly more stable, but when it comes nearer to the FOMC days, that's where it will experience higher volatility in the market space. Now, if you just look at gold as a performing asset, especially during time of high inflation levels, you can see over the time, especially US during the peak inflationary period, you can see gold actually increase quite tremendously. So in a way, it's compensating the persistent value rise in value across other major goods. So it goes to show that gold as an asset, it holds well, especially during an high inflationary period. And it does perform. So the key question is that if US were to hit into higher inflationary levels, I think this will also tend to benefit gold prices in the longer run. But I think Federal Reserve is keeping a close eye, especially on inflation levels. If inflation levels doesn't moderate much, I think interest rate is unlikely to come down further. And I think that's what boils to a question. It will have a lot of impact to many other major asset classes, and in this regard, it also have an impact on gold prices as well. Now, if you just look at this is an interesting chart. If you just look at gold prices and M2 money growth, you can see that they are moving quite in line in the sense that you have high rates of M2 growth. Usually, it signals to you that gold prices also tend to rise along as well. Now, usually rise in M2 growth will probably be a catalyst to fuel inflation levels. So in the sense that when there's more money flow into the system, rather into the economy, that eventually will also drive up prices, and that will also benefit gold prices in general. Now, if you just look at this chart, what we have here is the US interest rates against gold prices. So you can see period of low interest rate normally be a period where you start to see rising gold prices, because gold doesn't give you any interest. If you hold gold, it doesn't pay you dividend or interest. So obviously, when you have high interest rate environment, that means higher opportunity cost, and therefore people will actually opt for other assets rather than going into gold market. Now, if interest rates were to be very low, then there's obviously incentive to hold gold, or rather there's less opportunity cost. So right now is you can see that despite interest rate in US is actually quite elevated, but you still see gold prices actually reaching all-time levels, and that is because I think there's a lot of other important factors that's actually driving gold prices. But do watch out. I think as long as interest rates are pretty high, I think eventually there will be a bit of fund outflow from the gold market and into other high yielding interest rate or high yielding rate asset classes that gives you a better interest rate return. So I think that's an important factor to watch. But I think for now, what really drives gold prices, other important factors, especially got to do with demand. Demand for gold is what is boosting prices, in the near term. Now, when it comes to rate cuts, it's always a very difficult game to predict. In a sense that there's always a saying, don't fight the Fed, but I think it's really don't fight Trump, because I think Trump is pretty much a wild card, and whatever he says, whether it's but technically it shouldn't have any influence when it comes to Fed decisions. But again, I think Trump being Trump, he does display certain significant influence in certain areas of the economy, and so therefore, like it or not, it probably could be influenced when it comes to Fed decisions. So I think interest rate decisions from Federal Reserve this year is still looking at possibly about 1 or 2 rate cuts. That's the most that they're looking at. But I think the key thing to really watch out is that as long as the economy is not falling or faltering too much, unemployment rates are between their comfortable levels and inflation are quite moderate, I think interest rate will probably be where it is. But as long as inflation starts to pick up quite aggressively, which is I don't think Federal Reserve is comfortable enough. In fact, I think probably interest rate maybe even inch higher. So that's really a key element to watch out for. Now, all this will have an impact. Definitely will have impact for the markets, and in that regards also will have an impact on gold prices. So again, brace for more volatility, if especially heading into FOMC days, because definitely markets are going to be more volatile during those periods. Now, looking at dollar relationship with gold, you can see that stronger dollar usually don't usher well with gold prices. So stronger dollar usually signify a lower gold prices, because gold now is deemed to be more expensive because of the strength in the dollar. So a lot of countries, especially using their own currencies to buy gold, they may lose out in terms of competitiveness. So therefore, I think in that sense, when you have strong dollar, that usually be not a good point for gold. But what is significant now is that you can see dollar strength actually weakened quite substantially. Or in other words, I think the dollar has actually weakened quite considerably, given the fact that Trump tariff is kicking in, and I think that will have an impact when it comes to the US dollar strength. So now we have a scenario where it's weaker dollar, and therefore I think that's going to be a potential catalyst for gold prices going forward. So watch out on dollar strength. I think that will have a significant impact when it comes to gold prices. But then again, if you work on this relationship, there's usually bound to be a period of time where this relationship doesn't hold. Again, gold prices are not only influenced by a single factor. There's always multitude of factors that affect gold prices in general. It's just a matter of how much of a degree a particular factor that have a significant impact on gold prices. So keep that in mind. But I do believe that as long as we have a weaker dollar because of the Trump tariff, that should help boost gold prices in the near term. Now, in the earlier slides, one of the slides topic, we talk about de-dollarisation. I think it's an important topic worth to look at. Over the longer period, there's always a talk in town that say that US dollar dominance is actually losing its dominance. Whether it's as a reserve currency for the world, the share of US dollar as a reserve currency for the world is slowly declining. Especially you have seen major countries like US, like China and Russia. They are slowly actually trying to convert some of their US dollar reserve into gold or into certain other currencies. So really, I think it begs the question that whether US can continue to dominate the major global reserve currency space. I think it's bound to happen where US dollar will slowly lose its significance because of the fundamental of its own economy. And again, geopolitics aside, really, I think US dollar dominance is something that we really have to watch out for. Now, the key question is that a lot of, if you just look at how the China reserve trend is, they are slowly actually converting some of the US dollar assets into the gold market. So I think this is what's fueling the rally in the gold prices. Now, as long as China central bank is doing that, it's going to be a major catalyst for gold prices, or rather it's a major support for gold prices. Now, obviously, China is also a very sensitive buyer. They can't be buying gold prices at all-time high. They will have to wait, probably to be waiting patiently at the site whenever prices reach all-time high, hoping that there's a slight contraction in terms of prices where they can actually be buying into the market again. So do watch out. I think despite gold prices at all-time high, we can't be too optimistic that China will continue to buy all the time. There will be a period of time where China actually starts to slow down in terms of purchases, and I think they slowly wait patiently for prices to be traced before they enter the market to buy again. So really, I think US dollar dominance, is still significant in the sense that is catering almost 50% of global reserve in terms of US dollar. But I think that dominance will slowly start to dwindle, and I think significantly a lot of other major countries are slowly divesting their assets away from US dollar and into other currencies or even into gold. Now, if you just look at this is from World Gold Council, you can clearly see data points significantly that over the past 2 or 3 months, you can see significant growth in terms of demand, and majority of this demand growth is coming from central banks as well as investments. Now, investments in relation to ETF flows. So, if you are buying gold ETF, it will be recorded as an ETF inflow into the market. So central banks and investments are the two major demand drivers for gold in at least the past 2 or 3 months. So if you really want to know where gold prices will go in the next couple of months, just watch out on these two factors. As long as investment demand is still robust, central bank is still buying aggressively. I think that's going to be something that will keep gold prices above the 3,000 mark level. Now, so you can see that there's a huge inflow. I think once gold cross the psychological level of 3,000, it actually trigger a lot of buying interest. I think that's create a lot of it generates a lot of interest among the investors fraternity, and then therefore created a lot of buying potential. So ETF flows over the past easily beginning of this year recorded quite a positive inflow into the market, and this is what support prices going forward. So watch out. I think if you are trading a gold market, trading a gold market space, watch out closely on the ETF flows. Once the ETF flow starts to peak, usually that will signify that probably prices will peak during that period of time as well. So as long as ETF flows are still positive and still coming quite strongly into the market, it tells you there's still interest in the gold space despite the all-time high prices. It tells you there's still more upside for prices to go. Now, if you recall, I think there's on a news wire early of last month, you can see that the spot market for gold actually jumped quite considerably, especially when you look at US spot gold prices. In fact, you look at COMEX gold inventory is grown quite significant, over the period. Now, I think this is in conjunction with Trump tariff. I think a lot of people try to anticipate the impact of Trump tariff, and therefore, before Trump tariff is being implemented, there's always a rush to get physical gold or to move physical gold from certain locations back into the US market, just to avoid those tariffs. So that explains that also created a lot of interest, or a lot of interest in terms of generating higher demand for gold, whether it's on physical side or whether it's on paper contracts. In general, is putting a lot of demand into the market. But I think that scenario has that tightness has seen ease. The physical market is, if you just look at inventories in COMEX are still pretty high, but if you look at the lease rates, the rates that's being demanded for physical markets actually dropped considerably. So it tells you there's the tight situation in the market is slowly eased, and I think therefore physical prices will tend to reflect what future prices is already converging to future prices. Now, this kind of shock in the market is not unusual, but I think with Trump tariffs coming in, there's uncertainty. Obviously there's a lot of inflows or outflows from certain countries, and that will create interest or buying interest or demand interest in the gold market. And I think this kind of scenarios will probably be happening again. So with Trump tariffs as an uncertainty element, it will create a lot of volatility, especially in the gold market space. But over the longer run, with such a buying interest or demand interest for the gold market, is indeed will be a catalyst for the gold prices in general. Now, if you just look at demand coming from regions, you can see that Asia is still the strongest one, coming especially from China. Now, China's central bank buying is actually progressively very well. Despite prices at actually at all-time high, China's central bank is still aggressively buying. Now, whether that's a significant policy change, whether they are moving away from US dollar asset and into gold, that could be a particular reason, or whether it's for geopolitics reason. We can't know for sure. But as long as China still demand gold in quite a strong manner, that will be a strong factor to support gold prices. And I think if you want to watch out whether gold prices will break below a 3,000 level, you just have to watch out on whether central banks are buying or not. If central banks pause their buying or pause their purchases, I think that could be a factor that really can push prices even lower. So central bank buying is a major factor. especially for last year and this year. So do watch out whether central bank can continue to buy more in the next few quarters or so, because that's an important element to see whenever you want to analyze the gold market. Now, Chinese market is actually going very well. Despite central banks are buying, Chinese consumers are also buying. Again, I think because price of gold has actually surpassed the threshold, so it triggered a lot of buying interest. So I think Chinese consumers are also jumping in the bandwagon. But keep in mind, I think also because China economy is actually is still in the doldrums. They're still facing property crisis. So I think they're just looking for asset classes that where they can park their excess cash, and I think gold is one of asset class that's actually quite is luring some of these Chinese investors into the space. So therefore that explains why holdings and even the AUMs or Chinese gold ETF actually been inching higher and higher. So this is what I meant. If you just look at China Central Bank, they started aggressively buying since the second half of 2022, and they've been buying substantially since then. And even though gold prices are actually hitting all-time high levels, China Central Bank is still buying. Now, whether there's a motivation that drives behind it, whether it's political reasons or whether it's more of a strategic shift, strategic asset shift away from US dollar dominance, that could be any explanation. But I think what's key and important is that as long as China's central bank is buying, is a big factor, and it's actually what's driving the prices higher. So as long as China still buys, is going to be a major support. But if China starts to slow down and is pause their purchases because of the high prices, I think that's going to be a pause in gold prices rally as well. So keep that in mind. You have to watch China closely if you want to look at the gold market in general. Now, China itself, in terms of economy, is still in the doldrums. They are still suffering a bit of backlash when it comes to property prices. That's property issues or property crisis is not an easy issue to resolve. It takes time. So I think China is really going to be in a state of slower growth or slower economic growth for quite a long period of time. Now, until then, until we see a positive narrative coming from China economy, I think really whether gold strategic move to gold as a as a way to diversify, it could be one of the major reason. But I think if you are looking into equity space, China itself or China economy itself will probably be quite laggard for quite some time. So this is just trying to tell you that China consumer is also feeling the pinch. They are not that optimistic with their own economy, and as long as China consumers are not that optimistic, they're not going to spend, and therefore that will even propagate more negativity in the economy. So I think that's quite certain that I think China economic growth is going to be quite difficult going forward. Now, the reason I mentioned this is because despite, given that consumer sentiment is quite weak in China, it also goes to show that the demand for jewelry in general also tend to be sluggish. And despite high prices, that's also another contributing factor why consumers are slowing down whenever it comes to jewelry purchase. But keep in mind, I think if you just look at investment inflow and even the central bank buying, these two factors is more than enough. It's more than sufficient to cover the deficit in the jewelry demand. But I think jewelry is a very big aspect when it comes to, or it contributes quite substantially to gold prices. So therefore, if weak demand in the jewelry segment is also going to bring down overall demand for the gold market. Now, if you have been trading the gold market, there's also an important element to watch is basically the open position that's on the COMEX exchange. If you just look at it, the net positions that is in the market, over the time, the gold market in general has actually been going on the net long positions for quite a while. This and is supporting the price rally that we have seen in the market. What is important to watch is that if you just look at the net long positions as in the COMEX market, you can see that those net long positions are slowly declining. Now, usually in a strong uptrend market, when you start to see net long positions declining, usually that means that possibly be a peak in gold prices, because open positions, when you have a strong rally, you should have a higher, or rather you should see a higher net long positions along the way, because if you have a rally in the market, you should expect people to probably expect the rally to sustain, and therefore they should hold positions in the market. But if they expect that probably this rally cannot sustain itself, or probably prices has peaked, they will start to actually close some of their positions, and therefore close some of the net long positions, and therefore recorded as a you can start to see a lower volume of net long positions. And that usually, especially when it comes to price trends, and you start to see declining open interest volume in the market and during a peak rally, that usually signifies probably the price has actually reach a picking point. And important to watch, if as long as a couple of weeks later we start to see that open interest continue to decline, it's just telling you that a lot of people are taking this all-time high prices as an opportunity to close their positions. In fact, you should watch out net short positions. If net short positions are increasing, it's just telling you that most of the market participants are not anticipating that the gold rally can sustain itself over the medium term. So net positions are an important indicator, especially to look at where market sentiment is. So right now is quite unusual. I mean, all-time high prices are actually encouraging more of these invest or traders closing out their positions, or rather taking profit on their books, rather than adding more long positions to support the price rally. Now, if you just look at it, market volatility, if measured by VIX, which is an important market barometer for risk. Whenever you have high VIX reading, it usually indicates to you that the market is actually very fearful. And right now, you just look at where VIX is standing about close to about 19 to 20 index points. It's not to say it's fear in the market, but you just look at where the movement of VIX is for at least the start of this year. Is clear enough that when Trump comes into the picture, you definitely going to embrace more volatility in the market space. Now, over on a longer term period, whenever we have high VIX reading, usually that's beneficial for gold. So I think generally when you expect market to be more volatile, that usually will also be a good factor or good point to be looking at the gold market, because gold tend to be a asset classes that actually safeguard against uncertainty or risk of market risk. So whenever the markets are embracing more market volatility or more risk in the coming future, I think that's a good point in time to actually look at the gold market. Now, looking at trends in the market, clearly, gold market is actually a strong uptrend rally. And if you are a trend trader, there is usually a couple of trend tools that you can use. I think one of the commonly used tool is looking at moving averages. So moving averages tends to seek out where the direction of the market is moving. So obviously you can use different varying periods of moving averages, and try to plot the trend accordingly. Now, I think if you are using trend, it's also a good tool to use Heiken-Ashi candles as a way to detect trends. So Heiken-Ashi candles are very good tools to use, especially try to identify trend in the market. So as a trend trader, you trade with the trend. If the trend is a bullish trend, you find opportunities for you to long the market. So Heiken-Ashi is a derivation of Japanese candlesticks. It's very useful if you are trying to identify short-term trends in the market. Now, if you couple Heiken-Ashi together with moving averages crossover strategy, you get quite a good entry signals for you to find pinpoint entries that you can enter into the market. Now, directional movement index indicator is also a very good trend indicator, which tells you where the direction of the market is heading. But importantly, I think under the directional movement index, or DMI for short, there is one line called ADX. Now, ADX is very important if you are using trend trading tool. ADX measures strength of the trend, so it tells you whether it doesn't matter whether a trend is uptrend or downtrend, but whether it is important also, once you identify the trend or market, is also to identify the strength of the trend, whether there's still momentum in the trend. There's no point for you if you identify there's a bullish trend, but the bullish trend is almost at its peak. And if you enter during that time, you're probably bound to get whipsawed by the market. So importantly is to gauge the strength of the trend of the using the ADX value, which I'm going to share later part on how you can do that. Last but not least, I think in every trading decisions or entries or signals that you get, you must have a level or a strategy for you to get out of the market in case the market go against you. Now, I like to use the average true range or ATR for short as a way to pick my levels for me to take profit and stop loss levels. So I'm just going to show you certain examples for you can use whenever you look at ATR values as a way to measure your risk and reward. Now, if you just look at gold prices where it is clearly still an uptrend market, given that you just look at where most of the candles are, is still above the medium and the longer term moving averages. The 50 and 200 period EMAs is clearly that the market is still poised to go higher. So importantly, the 3000 is a psychological support level. If it does break that, definitely the market is going to hit to test the next critical level is 2009 or even below. So crucial to watch, can the 3000 sustain itself? It depends on factors as I just described earlier. And also importantly, I think, as I mentioned, in any technical rally that we've seen in any markets, is bound to have a slight correction, because if we have a strong technical trend on the upside without any form of correction or retracement, it's usually not a healthy trend. In a healthy trend, you should see a bit of retracement in prices. So I think go in this regard, should able to see a retracement pretty soon. And that retracement do happen, that usually be a next catalyst for the market to rally higher. Given that if the factors doesn't change much. Now, Heiken Ashi is an important trend too, because it depicts short-term trends. Now, if you just look at left chart, which is Japan's candlestick, and you compare that with Heiken Ashi, now Heiken Ashi shows you the trend or short-term trend by looking at the colors of the candle. So as long as the colors of the candle, like for example, you see red candles, it tells you the market is generally on a downtrend. If you look at the green candles, it generally tells you the market is on an uptrend. And the length of the candle is equally very important. If the length of the candle is wide and long, that tells you generally that there's a strong momentum in the trend. So if you're holding long or short position, you should be holding into the trend. Now, as if the candles gets smaller and smaller and almost a doji style candles, which almost like no body, is just telling you, the trend is exhaustive, is exhaust itself. It's time for you to close your positions and await for the next trend in place. So Heiken Ashi is a very good tool to raise spot short-term trends in the market. Now, Japan's candlesticks, to try to identify trend is not easy. In fact, I think the nature of Japan's candlesticks is pretty much trying to time price reversal in nature by the patterns and formation. So Japan's candlesticks in that regards is more akin to looking at when's a possible price reversal or trend reversal in place. While Heiken Ashi is actually looking at trends in the market. Now, the dynamics of Heiken Ashi is actually pretty simple. That's the reason why a lot of people, whenever they do trend trading, they use Heiken Ashi for the simple fact that the configuration of Heiken Ashi is quite mathematical. Therefore, you can actually use, if you are using automated trading or algo trading, you can actually compute the formula for Heiken Ashi. But what's important is that just looking at the candles, the color of the candles and the length of the candles is telling you pretty much a good story on where the trend of the market is heading and the momentum of it. So I mentioned earlier, if the candles are red and if the body of the candles are white, it's telling you this downtrend momentum is strong. Vice versa, you start to see green candles with long body, is telling you that the bullish momentum is in place. Now, keep in mind, when you start to see body of candles are getting smaller or almost like a doji candles, it's just telling you there's no trend in place. Or if it's coming from an uptrend, it's telling you this uptrend is almost exhaustive. It's time for you to take your profit on your long positions, or in fact, look for the next trend that's going to be in place. So importantly, there's only three configuration you need to know. One is to look at the color of the candle. If it's red candle, it's telling you it's a bearish trend. Green candle is telling you it's a bullish trend. If the body of the candle is white, it's telling you there's momentum. And if there's a series of red and green and the bodies are very small, almost like a doji style, it's telling you there's no direction, or rather there's no trend in place. Now, keep in mind, if you have no trend in place and if you try to use trend trading tools or trend strategies, it will not work. In fact, I think especially when you try to, the markets are moving sideways, there's no clear trend. If you use trend tools, usually you get a lot of whipsaws. So that's important to identify when trend is starting to be in place. Now, just having Heiken Ashi is not sufficient. If you want to get better entry signals, you can pair it with moving average crossover strategy. So moving average crossovers are very simple. You take two different periods. One is a shorter, one is a longer period. So whenever you have for example, a bearish crossover moving averages, is when your shorter crosses below. Now, if you couple that with Heiken Ashi candles, you start to see red candles with long body. It's generally quite telling that this trend is heading down on the downside. So if you pair that with Heiken Ashi, you probably get a pretty good signals on trying to identify where the trend is coming to place. Now, this bottom part here, the bottom panel, is what we call a DMI indicator. I'm not going to go too detail on how to derive DMI. Now with technology, most of the charting tools will provide the DMI trading tool for you. What is important to take note is that the dynamics of it. So, DMI this consists of the positive DI and the negative DI and the ADX line. So this green one is what we call positive DI, and the red one is minus DI or negative DI. So the crossover is simple. The moment a positive DI crosses above the negative, it's just telling you there's more positive momentum in terms of price. If you can confirm that with Heiken Ashi candles, as long as you see green Heiken Ashi candles and it's above the moving average, or whether the moving average crossovers are bullish, it generally tells you that this is a good entry for you to take a long position. Vice versa, if you start to see negative DI crosses, above the positive DI, is telling you the market is poised on a downtrend. So it's crucial. I think if you want, the reason why I put DMI as a trend tool here is it's not for the DI, the positive DI or negative DI crossover, because if you just look at it as signals, the positive DI and negative DI crossover signals are pretty similar with your moving average crossovers. But what is important in DMI tool is what we call the ADX line. This is the black line. Now, ADX is a crucial tool as part of the DMI indicator because it measures the strength of the trend. So there's a common rule of thumb. As long as ADX value is below 25, it's just telling you the market there's no trend. So these are the periods where there's no clear trend in the market space. So during this period of time, if you are using trend trading tool, it may not work because ADX value is below 25. It's just telling you the market is moving sideways. So in sideways market, you have to use other style of strategies, usually the mean reversion or whatnot. But it definitely cannot use trend trading tool, because trend trading tool are used mainly when markets are trending. So the moment when this ADX starts to cross above 25, is telling you that there's trend in place. Whether it's uptrend or downtrend, it doesn't matter. It's just telling you that there's a trend in place and the strength of the trend is gaining. So like for example here, when you see ADX is rising above 25, this uptrend that you see, there's strength in the uptrend, and it's continued to hit a peak here where you start to see that this uptrend starts to go sideways whenever ADX starts to peak. So ADX is a very good barometer to measure the strength of the trend, and it's actually part of your DMI tool. Now, if you come to compute as a way to find an entry strategy, one of the ways is to look at the Heiken Ashi candles. And if you pair with moving average crossovers, as long as the candles are above both the moving average crossovers and the moving average crossovers are bullish, it's telling you that this is a good position to enter. Now, importantly, you can also pair that using DMI. The DMI crossovers, especially a positive DI and negative DI, is giving you the same signal as your moving average cross. So it is an overlap. But importantly, why we use DMI is actually for the ADX. So ADX starts to go above 25, it's telling you there's pretty much an uptrend in place, and possibly that this uptrend there's still momentum. There's still momentum in it. So there's still strength in this uptrend. Now, the last bit of this panel is showing you the ATR value. Now, ATR value stands for average true range. We measure the true range of the particular period. So in this particular period, it's actually 18 points. So what we can do is that, if you have a signal for you to long gold price at 2600, your ATR value is at 18 points. If you work on risk to reward ratio 1 to 2, you're looking at 18 points as a way to manage your risk. If the market go against you by 18 points, you're out of the market. Obviously, your target reward is 2 times of your risk. Now, this risk to reward is actually very individual. There's certain individuals prefer higher risk to reward or lower risk to reward. It's very individual. But I think we need to have a set of strategy to get you out of the market in case the position go against you. So ATR is a very good way to manage your risk, especially when markets are very volatile. So now this is what happened next, because as long as the momentum in place, the ADX is rising, it's telling you that this bullish trend is still there's still strength in the bullish momentum. Now, when ADX starts to pick, that usually be a point where, if you're holding long position, you should be out of market. Now, there's a couple of scenarios here. One way is, if you just look at the previously example, you should be out of market at 26.36 because that's the level you base your ATR value with. Now, if you just look at ADX, there's still potential that this uptrend can still go higher. Now, for me, it's simple. If you have a trend for you to get in and get out on the market, you should follow your plan. Keep in mind, markets are always present in opportunity. Once this opportunity is done, there's always other set of opportunity that's in the market. So make sure that you're disciplined enough, to adhere to your plan that you have in place, and to follow your trading plan accordingly. Now, just moving to the last bit, if you just look at where gold prices is right now, like I mentioned, the net positions in the market, net long positions in COMEX market is actually dwindling by week. So it goes to tell you that probably the rally that we see in gold prices probably may face a bit of resistance at the current juncture. True enough, ADX is slowly starts to moderate. It's telling you that probably the market is going to sideways for in the shorter term just to try to consolidate. And it's important to watch. If it does break down below the moving average crossovers, it does indicate to you that 3,000 is definitely not going to hold. It's definitely going to test levels that's lower than 3,000. But again, I think DMI is, in terms of ADX value, is still showing you that the uptrend is still a bit of momentum, but the momentum is slugging behind. So do watch out. If you are holding long positions, I think that's a good point of entry for you to really look at getting out of your long positions out of the market. Now, ATR value is interesting. It's rising. This is daily ATR. It's telling you that daily range of the gold market has actually been extending. So it's in a way, it's a good thing in the sense that there's more volatility in the market. But if you are using ATR to manage your risk, it's also telling you that with higher ATR value, you have to manage a higher risk. So you have to manage your risk accordingly. No, you can't place too tight of a stop loss, because if you place too tight of a stop loss, you get stopped out quite easily, especially when you're trading the gold market. So higher ATR value does generally tells you that you have to prepare to buffer a bigger set of risks despite the market volatility. So conclusion, I think gold uptrend rallies still remain intact, but I think sentiment may change with what is important to my view is that the open interest positions are not increasing, and in fact it's declining, and I think that's usually be a sign that pretty much the market has the short-term rally that I see in the gold prices probably has peaked. Now, if you ask me for where gold prices will go, if you just look at some of the key forecasts by some of the major banks, they're still looking at easily above 3,000 by year end. But I think technically you have to look at where the technical perspective for the price momentum is. You just look at where the ADX is telling you the short-term rally that is seeing gold prices is facing a lot of resistance. If there's not much of catalyst that can bring prices higher, probably should start to see that gold prices will start to retrace. Now, obviously, the next key support, if it does break the 3,000 level, is just looking at the 2870, which is coincide with your 50 period EMA level. If it does break that, it's technically telling you that gold is heading for a short-term downtrend. So that's important to watch. That level is key. But rather, I think the psychological level that everyone is watching is a 3,000 level. Now, if you just look at over the longer period, gold prices has actually displayed quite a lot of volatility across the board in terms of ATR value. Those days, if you recall, gold market doesn't move much. Per day range is probably looking at $20, the max you can go. Nowadays, you're looking at easily $40 to even $60 range. It's quite a huge price range, and therefore, if you are trading the market, you really have to make sure that you have a stop loss in place, and that's sufficient for you to cater for such a big buffer. So I'm just going to end here with a quote. I think Alexander Elder is a very great trader. You can read some of his books. I think he mentioned this quite timely and quite succinctly in the way that the goal of a successful trader is always to make the best trades, and money is always secondary. And given that the market is so volatile these days, it's important that you make sure that you have to preserve your capital for your next couple of trades. So risk is definitely a paramount important factor to consider. So with that, I'm just going to end it here and pass it over to Minghui for the Q&A.
All right, thank you so much, David. We do have some time for a couple of questions. So to everyone watching, do take this chance to send in any questions you may have about the gold market. And David, I'm sure there are a few questions that have come in already. So if you could find
Yeah,
them,
sure.
yes,
Okay, yeah.
yes.
Okay, there's a couple of questions. So I'm just going to address a couple of them. So the first question is where we see the net short positions. Now, that's a good question. Net positions, you can get it. You can get the data from Comex Exchange. They do. I think on a weekly basis, CFTC does report the net positions in the market. Net long, usually they report net long and net short positions. Overall, the market is usually for gold market is usually a net long position. So what's important to take note of is once the total overall net long position starts to dwindle, that usually be a sign that pretty much the market is the bullishness in the market is probably going to reach a peak. Now, for overall net short positions in the gold market is quite rare in the sense that people don't really go that bearish in the gold market. Generally the market is still a net long position. So, but having said that, you still can see a net short positions by some of the key players in the market by just looking at CFTC report. So CFTC report is comprehensive enough to show you the net long and net short positions. Okay, so next question is when Russia and Ukraine Middle East ceasefire geopolitical risk reduce, uh, is it bad for gold? Now, definitely, I think it's as long as there's less of a trade, there's less of a political tension, whether it's Middle East or whether it's Russia and Ukraine, whether there's a trade deal or whether there's a peace deal, that generally will affect gold. But having said that, markets are still quite jittery. You just look at how, the funny thing is that I've not shown you a period of time. You just compare the S&P 500 and gold prices in general. You can see that there's a bit of positive correlation in a sense. So whenever you see periods where there's strong equity performance, in general you don't see strong gold performance. Why? Because strong equity performance means generally the economy is doing well. But when you start to see there's correlation in the sense that it's what we're seeing now, strong equity performance, strong gold prices, it's just telling you people are starting to look at gold as a way to diversify their risk. So generally, despite I do agree, political risk once it's reduced, it's actually going to mean that there's less appeal for gold. But I think there's also other elements that to consider, especially with regards to gold being a good asset diversifier. So just to answer the question, reduce risk of geopolitical tension, I think that's going to be something that's bad for gold in the near term. Okay, next question. The data for central banks buying published 1 to 2 months after they stopped buying. Isn't price already priced by the insider? That's a good question. Unfortunately, I think yes, we don't get consistent or up-to-date data regards to central bank buying. Unfortunately, we don't have that. In fact, I think if prices will move, usually move quite ahead of the elements when it comes to central bank buying. So normally, I think what we can do is that what I believe is that as long as prices remains where it is or remains high, that usually be a pressure point for especially for Chinese consumers. Now, one of the key data that's worth to watch at also watch quite closely is quite current is the jewelry demand. Now you can get that from India Gold Association, because India is a dominant country when it comes to jewelry demand. Keep in mind, jewelry demand is still a strong factor. Now, obviously, central banks are very late in publishing their data, but I think given that the momentum that we see in China overall, they're bound to be a pressure point or pain point when it comes to prices where they start to slow down. Usually that will reflect in prices. So whether that, if you're an insider that who knows what the central bank is doing, you can capitalize on that. That may be a case, but I think central bank buying is not the only element. You still have other important factors like the jewelry demand, which the data you can get quite is updated quite up to date and quite concurrently. So I think unfortunately, I think central banks, because of the lag of publishing data, there's still usually there be a lag. So I think that's usually be a point where we need to maneuver. But I think usually prices will reflect that. As long as you start to see prices cannot hold above 3,000, usually it tells you that central bank is actually slowing down, and you can see that probably in months to come. Okay. There's also a related question to that. How do you monitor central bank purchases? So you can get that from World Gold Council. World Gold Council is a good website. It's a resourceful website that actually gives you all the important data to look at and to observe with regards to the gold market. So you can get that from World Gold Council. And I just mentioned when it comes to central bank purchases, it's slightly going to be delayed because it needs some time to gather those information. And in fact, I think if you just look at China, certain data that's coming out from China may not be that transparent. So it's very hard to collate those information. Therefore, it actually explains why central bank data tend to be a bit more late. Okay, how do you monitor funds flow into investment ETFs such as GLD? Again, World Gold Council will publish that every monthly. You can start to see ETF flows on the GLD from the World Gold Council website. They do publish it quite regularly when it comes to ETF flows. Okay, what's your projected price floor for gold if the US slips into a short-term or stagflationary situation? Short-term referring to 6 months period. Now, price floor for gold, one of the ways to look at it is to look at all-in supply costs for gold. Right now, the all-in supply cost for gold is about 2001, 2002. Some of the major gold miner or rather gold producers. Whether that could be a floor for gold prices in time to come, that's one way to look at it. But I think if US were to fall into a stagflationary environment, which I mentioned earlier in the beginning of the slide, they probably are right now, gold tends to benefit. And I think that could be another catalyst that actually can bring gold prices above 3,000 and sustain above 3,000. Now, whether that will play out, again, is still much to be seen because the Trump tariff impact is still yet to get full form. Once we're able to better gauge how the impact is actually, or how the tariff actually impacted the market, then we are better able to assess how it can actually create chaos with the economy. I think right now is still pretty much an announcement that is pretty much anticipated, but I think the actual impact is still yet to be felt. So I think in general, if US were to fall into a stagflationary environment in the short term, I think that generally will benefit gold prices. Okay. Again, I think there's one question here: is it possible, or for gold to hit 4,000 per ounce? Will it price crash when Russia-Ukraine war is stopped? Now, I would say geopolitics will have a quite important element. Whether it will cause a crash in gold prices is unlikely, but definitely going to be a retracement in terms of gold prices. So again, I think that's why I think people are also expecting that with Trump that's being in place and playing the wild card here, if there's a peace deal that's in reach, that will probably be an element to bring gold prices lower. That could be a temporary correction, but to see a price crash for gold market, if that were to happen, is unlikely. Now, for the next question is whether gold can hit 4,000 per troy ounce. I mean, I wish I know where gold may hit to that level or when. Because that's like almost like having a crystal ball. But I think the factors that's actually supporting gold prices are still there, still evident and still supportive. Gold can still go higher. But I still believe in terms of technical perspective, it should have a correction in time to come, because in any healthy trend, we bound to see a bit of to see retracement, especially in the uptrend rally. And I think we probably will see that pretty soon. Okay, I'm just going to answer one more last question given time. Um, okay, so this audience asking me is, since I mentioned gold price is poised for a healthy correction, do I have a price and time frame target on when might be a good area of entry? Now, in terms of time frame, I wish I know, because that's almost like having a crystal ball. Now, in terms of price, like I mentioned, 3,000 generally is a psychological level. If it does break that, if you just look at where the 50 period EMA price level is pretty much at 2870. If it does break that, that tells you generally the market, the gold prices is heading for a technical short-term downtrend. So important to watch out. So sentiment can change. Whether that will coincide with peace deal or not, that's anybody's guess. But I think if just look at for correction wise, I still believe the 2870 should hold. But if it does break that, it breaks the 50 EMA level or 2870, it's actually technically telling you the gold price is heading for a short-term downtrend. Okay, so with that, I'm just going to hand it over to Minhui for the end of the webinar.
Okay, cool. Thank you so much for the insightful session, David. And like David said, due to the time constraint, we will end our Q&A here. But please feel free to drop any more questions you may have into the survey that will pop up later on, and we will get back to you via email. And before we end the session, allow me to share my screen again so that I can share with you a very exclusive promotion we have running right now on gold trading. Yeah, so from now till 30th of June, you can trade gold on our flagship trading platform FlipNova 2.0 and receive a pair of Golden Village Gold Class movie vouchers. So experience true multi-asset trading. You can take your pick from gold ETFs, gold futures, gold options, and spot gold. Scan the QR code on the screen to learn more about this exclusive promotion. And with that, we come to the end of the webinar. Thank you again, David and Sam, for the sharing, and thank you everybody for your time tuning into this webinar tonight. Feel free to send in your questions again, like I said just now, and we will get back to you via email. And we'll also be sending everyone a link to today's webinar recording so you can watch it again if you would like to. And that's all for today. Thank you, everyone, and have a good night.
Thank you.